Hi there, I'm Natalie MacDonald and you're watching another Sydney Direct, where we interview a market insider on all of the very latest happenings on Australia's financial markets. Now, the connection between the FX market movements and central bank activity is a long debated one which hopefully my next guest, Lewis Cooper, Managing Director of OANDA Australia, will be able to give us a little bit more insight into. Now, firstly, what would you say the level of correlation is between central bank activity and FX market movement?
In summary, I think there's huge correlation, not just with the FX market, but generally in all capital markets. But looking at the Forex market, since we've engaged in this low interest rate environment since 2008, there's been a massive outflow of volatility in the FX market, and investors are looking for, or historically been looking for, better yields from other asset classes. Now, the main beneficiary of that up until recently has been the global equity markets, and we've seen global indices trading in the last 12 months at multiple year highs. And there's a concept of relative free money out there at the moment, which is giving investors the appetite to take on more risk and generate income from capital appreciation from stocks. However, in the last couple of months, which is very well documented now, that the possibility of increased rate divergence in the global market, and specifically the US and to a lesser extent the UK growth story versus the issues around Japan and the Eurozone in terms of inflation worries and contracting economies, has led to increased volatility, and I think that will support increased volatility through to the end of this year and well into 2015. Which presents a really good opportunity for traders.
You touched there on volatility. Now, the Federal Reserve really has been the key driver for global FX markets throughout really the last year. With QE3 then brought to a close, how does that shape that much favoured volatility factor?
I think increased possibility of rate divergence is going to create more volatility and volume in the markets, more so now than we've ever seen before. I think the strong US fundamentals is just is making investors look at calculating, anticipating the size and extent of a US rate hike. For example, fixed income traders are already pricing in a rate hike towards the end of H1 next year. And this is in stark contrast to the Eurozone and Japan, who are looking at the possibility of further easing and dealing with the demons of inflation and possible deflation in those economies, which is why we've seen the US yen trading at multiple year highs recently, and there's been constant pressure on the euro in 2015. Meanwhile, intraday volatility is being driven predominantly by fundamental economic announcements. So traders are looking consistently at central bank announcements for direction. I'll give you an example of just last week. Investors completely shunned the Great British Pound off the back of the Bank of England announcement they're cutting significantly their growth and inflation forecast for 2015, and immediately investors are interpreting that as less likely of there being a rate hike in the UK next year. So at the moment, all of these announcements by the central banks, almost all of them are moving the markets and creating instant volatility, which again is an opportunity for traders if they have the risk appetite.
You touched there on the Eurozone, and this month does mark the ECB taking on its new role as banking supervisor. Almost simultaneously, you had international investors flocking to Australian bonds as Eurozone growth targets were slashed. What does this tell us at the moment about traders' risk appetite?
I think it tells us a lot. I think in a low rate environment, investors still want high yields. So that leads investors to taking on more risk in order to get those higher returns. And I think the fact that people are investing in and gravitating towards Australian government debt is a sign of that's occurring right now. And despite the fact that I believe the Australian dollar is undervalued and it's under consistent pressure from the dovish tones of Governor Glenn Stevens, the fact is that the Australian debt paper is ultra attractive to central banks, to investors and speculators alike because of the returns. Investors want high returns in any market condition, and at the moment with the strong interest rates relative to the other global economies, Australia is where it's at in terms of that appetite. However, we've talked a lot about the US economy, and eventually stronger US yields and a stronger US dollar will put pressure on the Aussie carry trade, as we call it. and we'll see investors gravitating more towards the US economy and assets as a stronger yielding asset class.
Finishing up then on the Australian markets, if we've got RBA policy set out pretty much for the next 3 quarters, and as we've already touched upon, a consistently weakening Aussie dollar, could this perhaps push domestic traders into maybe those riskier EMs to get that return?
Look, I believe that the emerging market economies are still heavily influenced and at the mercy of an imminent US rate rise. Until we understand or get clarity on the timing and the significance of that rate rise, I think you're probably going to see emerging market assets receive a small bid. But as we saw in late summer of 2013, I believe that what usually happens when there's an imminent rate rise in the US is that you see a massive outflow of investment in emerging market economies, and I don't think there's anything to suggest that will be different this time. So, once the rate rise does happen in the US, expect to see a huge portfolio shift in capital markets towards US asset class, because at the end of the day, the US economy still remains the best of a bad bunch in terms of ROI.
Great comments there, as always, from Lewis Cooper. That is all we've got time for right now. However, do stay tuned. I'll be bringing you plenty more insights right here from Sydney, Australia. For now, though, it's goodbye.